It was a pretty quiet day on Wall Street with the S&P 500 closing lower by 0.22%. However, there was a pretty nice little bounce off of the lows of the session when the market was down close to 1% here in the morning hours. But we did see a number of stocks fighting back. One of the stocks that managed to do quite well was Apple. Another one was Tesla, so that helps from a large cap perspective. In tonight's video, we're going to take a look at what's happening with the technology sector in particular, and we'll notice some slippage in the sector selector rankings. At the same time, we're actually seeing a little bit of buoyancy out of the utility stocks that had otherwise been getting beaten up here pretty bad earlier this year. In addition to that, we're of course going to look through all of the different 12 grids, including what's going on with interest rates. The 10-year Treasury yield finds itself basically at multi-month highs here as we speak. And of course, tomorrow's a big day with Jerome Powell and the FOMC coming out with their interest rate decision. And then, of course, in tonight's trade application example, we're going to look for an opportunity of a bounce of a tech stock up and off of its rising moving average that we can set up as a bull put spread. So with that, let's go ahead and get started. Welcome to the Market Outlook video presented by MarketScholars.com. I'm your host, Brandon Van Zee. It's September 19th, 2023. First of all, if you're new, welcome aboard. Remember to go over to YouTube, click subscribe on our channel, then go down below into the description area. Make sure you're signed up for our email distribution list so that way you can be notified whenever we post these videos. Also, just a friendly reminder that I will be out of town this weekend, and so I won't be here on Thursday. So there will not be a video on Thursday, but as far as I know, David should be around, so I imagine he'll get one out on Friday. But just make sure that you take a mental note of that, not to expect a video on Thursday. I will be back next Tuesday, however, so a week from today, be back in the saddle, so to speak. In addition to that, we're heavy users of Twitter, or what they refer to as X these days. If you're not doing so already, I would encourage you to follow me at Brandon Van Zee as my handle. And we really appreciate those of you that click like and retweet on these Market Outlook related posts. And then last but not least, we do have a presence on Facebook. Feel free to join our group at that web address you see in the logo in front of you. All right, let's go ahead and jump into today's trade activity. And it was a kind of a mixed day, kind of a blah day. And I'm feeling it myself. For some reason, I feel like I'm coming down with a little something here. Of course, as luck would have it, right before you got an out-of-town trip, right? But it seems like the market had a little bit of a funk that it was trying to work through here today as well. The good news is we did have a little bit of a rally towards the end of the day. And although we still closed in the red, we did pare our losses quite dramatically. At one point earlier in the session, we were down about 0.75%. We only closed lower by 0.2% when it was all said and done here today. So some of these that would have perhaps been red squares earlier in the day did flip to green as the day went along. So let's go through and see what we can learn here. Let's get started with the red side of the ledger, and the ones that stick out to me, probably Disney catches my eye, down 3.6% here today. I believe it was second only to Intel, which was down 4.34%. So those two were the worst performers in the S&P 500. I know John Deere was amongst those as well, down nearly 3%. And so those three had some above average moves. Now, of course, they're not the largest companies out there. For that, we might turn our attention a bit more to Amazon, which had a little bit of a tough day, down 1.68%. In terms of the other Magnificent Seven types of companies, we also had NVIDIA down today over 1%. Microsoft was down 0.12%. Now, keep in mind, Microsoft did announce their dividend increase today, so a lot of us have been waiting for that one, and came through with flying colors once again from that regard, raising their dividend by over 10%. Keep in mind that Apple has also grown their dividend for many years in a row. However, Apple has not been particularly generous with their dividend growth policy the way that Microsoft has. So a lot of us were pleased with that double-digit dividend increase announcement out of Microsoft. Didn't help the shares today, but obviously the stock has gone up tremendously over the years, and so it's not really driven by the dividend per se, but still nice to have a little extra income for the shareholders there. You can see that Alphabet/Google was down just a touch, basically break even, a little bit below break even, down 0.09%. And I think that was it for the Magnificent Seven in the red. In terms of the other Magnificent Seven companies, Apple was up 0.62%. We did have Tesla up 0.46%, and then Meta was up 0.83%. So kind of a mixed bag, not just across the broad market, but even within the Magnificent Seven itself. Remember, more times than not, they kind of travel together, but today, not really the case. In terms of other areas that were kind of out of favor here today, notice that the energy area really took it on the chin. Keep in mind that had been one of the only uptrending areas within the market, especially from a sector perspective. And so today was a give back day within energy. Some of those that took it across the chin a little bit more were Marathon Petroleum down 2.6%, EOG was down 2.18%, Halliburton was down 2.84%. So not any love there from oil today, the way that we've been experiencing for much of the last couple of months. Let's turn our attention now to the green part of the ledger, see what we can discover. Adobe catches my eye. We'll actually be talking about that a little bit later in the video, but it was up 1.74% today. Let's see what this one was down here. This is Enphase Energy, not a very big company, but still up 4% in the market today. I think that was the best performing stock in the S&P 500. CVS had a pretty good day. It was up 1.82% there. You did have, some of those telecom stocks in the green, AT&T and T-Mobile, both closing in the green. Pfizer and Lilly both closing in the green as well. Even the auto stocks kind of followed in line with what we already mentioned with Tesla being higher. Ford and GM were both up today. Of course, they've been in the news quite a bit here recently with some of their negotiations with the unions there. Etsy, not a very big company these days at only an $8 billion market cap, was the one of the larger movers within the S&P 500 today. I think it was the third best performer, up almost 3% here today. Some of those biotech stocks managed to close in the green as well. Vertex, Regeneron Pharma, Moderna, Biogen, IDEC, and then Insight, all closing in the green. That one trade that I did on the CRISPR stock, not really working the way that I want it to yet, but as I mentioned in that particular video, it was a pure speculation, and we are fully expecting to lose the entirety of the options contract, but in the off chance that it works out for us, perhaps there could be some bigger upside, but right now hasn't really started off on the right foot for us quite yet, so we'll keep our eye on that one, but at least some areas within biotech seem to buck the market sell-off here today just a touch. Some of the insurance companies as well, they kind of caught my eye today. They are really not a very wild part of the market. You don't have a lot of press, a lot of people talking about it on CNBC or what have you, but there were some nice moves out of the insurers, so keep your eye on that traditionally sleepy part of the market. AJG, which is Arthur Gallagher, was up 1.15%. Progressive was up 1.3%. Allstate was up over 2%. Willis Towers was up 2.4%. AIG was up over 1%. Aon was up 0.6%. So some pretty nice performance. Even Aflac had a decent day there, up 0.59%. So as I was going through various charts looking for trade setups for tonight's presentation, I did stop upon a number of insurance-related names that looked like they were bouncing pretty well. So keep your eye on that area. All right, let's go ahead and come on over to the main part of the platform now and try to discover how many stocks were up versus down in the S&P 500. So let me pop over here. I had to restart my platform. It's been kind of wonky because it seems like it's sending me error messages. And this is the new Schwab related Thinkorswim login that I'm using here. I noticed that I still have access to some of my TD Ameritrade ones, and those ones are working just fine. They're not having a little error message pop up, but for whatever reason, as I was going through many different charts on the Schwab version of Thinkorswim today, I was getting all kinds of error messages. So hopefully they get that resolved at some point before too many people start using it. So here's the S&P 500. You can see that about 201 stocks within the S&P 500 closed higher today. About 297 closed lower. So kind of matches with what we would have expected with the market's end result of being down 0.2%. 0.21%. All right, let's go ahead and do some analysis now on the 4 grid. And as you can see, we've got a bullish posture back on the S&P 500, somewhat surprisingly, considering the market was down 0.22% today. And we are down below the falling 30-day moving average. But I guess since we were able to climb off the lows of the day so effectively, we were able to swing that posture around. As you can see down below here with this green line, it looks more flat to the naked eye, and so I wouldn't read too much into it. If we have another sell-off tomorrow where we close near the lows of the day, I would venture to guess that that green line could very well roll over, and then we'll be back to a bearish posture with the market forecast once again. But for right now, at least there was some resilience within the market today, closing well off of the lows, even though we still closed a little bit below yesterday's close. In terms of the range, we had about a 33-point range today, which was a quiet day compared to what we had been experiencing, which was a little bit closer to about a 40-point range from high to low here more recently. And you can see that those blue labels do show up across all 4 of these charts here, telling us that across the board it was a quieter day, which is a little surprising. There was, as I mentioned, we had a little bit of a sell-off in the morning, and then we rallied back, and you would think that a day like that would come with a little bit of an outsized range, but I guess it just wasn't in the cards here today. Anyway, back to that bullish posture on the S&P 500. Let's talk about the Dow Jones Industrial Average now. You can see that it was down 0.31%, so it was down even more than the S&P 500 today, but similar to the S&P 500, notice that long lower shadow that you have on the candle here today. You have what could be more of a hammer type of candle formation. Of course, we would need tomorrow to confirm that, right? We need to close above today's high tomorrow, and we can look back and say, yep, that was a hammer. But if we roll over, then it's just a continuation of whatever the pattern was prior to it. So we'll keep our eye on that. But at least, again, we were able to get well off the lows by the time the closing bell rang. You can see that the the Dow Jones Industrial Average 30-day moving average is red here, telling us price is below that falling moving average. And you can see that's the case with all 4 of our charts as well. So all 4 of them had below average range days. All 4 of our charts remain below their falling 30-day moving averages, which generally is not a particularly bullish feature. So I want to keep our eye on that as we head into some of these choppier periods. I think it was Ryan Dietrich today on Twitter was saying that the next 10 days are traditionally the toughest days for the stock market during the year. And so we'll want to brace ourselves from a seasonality perspective. Not to say that that works out exactly that way every single year, but on average, the next 10 days throughout the years has produced a little bit more selling than buying. So prepare yourself for that possibility. On the downside of the 4 charts here, let's start over here on the left-hand lower corner. We've got the NASDAQ Composite. It was down 0.23%, which did actually come pretty much in line with the S&P 500. So both of those managed to be kind of the better performing indices here today. That very well may have been because of the strength in Apple. Remember, Apple's going to have an outsized impact on those particular indices as it's the largest publicly traded company out there. So the NASDAQ fared a little bit better than some of the other indices, but as I mentioned before, still remains below that falling moving average. However, similar to the S&P 500 discussion, notice that we did flip back to a bullish posture here today, likely because we closed so far off of the lows here today. But I'll say the same thing, which is if you look at the green line down below here underneath the NASDAQ, it looks basically flat as a board. So yes, technically there's a slight tilt there, which is why the background color gets painted green, but it is not an emphatic move by any stretch of the imagination. So if we have a day of selling tomorrow, it's entirely possible that both the S&P 500 and the NASDAQ Composite go right back to their bearish intermediate postures once again. And then over here on our Russell 2000 chart, remember this is the small caps, and they've been doing quite terribly here recently. You had a day or two of interesting developments in the last month when the banks were able to get a little bit of a bump higher, but for the most part, it's been a little bit of a tougher go of things for the smaller companies out there. And you can see here that things are so bad, maybe they're good, right? That's kind of the hope if you're looking for opportunities within the small caps, because we do have these two little green dots showing up underneath yesterday's candle and today's candle. You can see that they correspond with these two green dots down below in the indicator as well. Remember, you can right-click on this chart and maximize it if you're a premium member of Market Scholars. Anyway, what that signifies is that the blue, the red, and the green line on the market forecast technical indicator are all in the low reversal zone below 20 on the same day. And when that happens, these little green dots appear. And what they're designed to showcase is that there's been an extreme amount of selling to the point where we might have an opportunity for a reversion to the mean type of a move, right? And since the 30-day moving average kind of represents the mean in this case, moving back towards it is what that would represent. Similar to over here, we had one of these red dots show up when the green, the blue, and the red lines were above 80 or the upper reversal zone. That can mean an overbought cluster signal. You kind of went sideways for a week and then you spilled over after that. So could we see a little bit of a reversion back higher on the Russell 2000 from these levels? I think it's possible, but keep in mind that you don't use any one technical indicator in isolation. You also have to recognize that we are awfully close to breaking down to multi-month lows. And I mean, we are very, very close. The low for the Russell 2000 on the last 3 months was back here on June 23rd, and it was 18.18. Right now, we're at 18.26, so we are not that far away. It could happen as soon as tomorrow. So we'll keep our eye on that, but there's also the possibility that that's a head fake. Sometimes the market makers like to play head games with you, and knowing that a lot of people may have their stop losses below that low back there, and with us being so close to it, it's possible the market makers push that through the low, making a lot of people assume the path of least resistance remains to the downside, and they better act accordingly by shutting down their bullish trades or perhaps loading up on the bearish ones, only to frustrate them and whip that market right back up to the upside based upon some of those oversold conditions. So be prepared for that possibility there as well. But without a doubt, we do remain with the strongly bearish posture on the Russell 2000. And this is the one that has maintained that strongly bearish posture the longest. It has been bearish posture here since, September 6th. And so really the last couple of weeks we've remained in that red background color, whereas up above with these other indices, it's kind of hit and miss going back and forth as we're trying to figure out what direction the market wants to go. It's been a little bit more consistent selling down there with the Russell 2000. But again, oversold cluster signals, so let's keep our eye on the possibility of some sort of a quick little reversion back towards the upside with that one. All right, let's go ahead and now take a look here at our 3 green arrows strategy. And as you can see, 3 of our charts actually have 3 red arrows, not 3 green arrows. When the background colors are pink on this chart setup 4D, it means that we have what's known as a 3 red arrow signal. And for those of you that are not familiar with that terminology, it dates a long ways back when David and I used to work with each other at Invest Tools, which was owned by TD Ameritrade. That was one of their big descriptors of setups, was the old 3 green arrows strategy. So we continue to refer to it from here to there, but it's really just a colorful way to talk about 3 different technical indicators and whether they're lining up bullishly or bearishly at any one given moment in time. And when you have 3 red arrows like we do right now on the S&P 500, it's telling you that the 30-day moving average has a red arrow because price is now below that moving average. We have a red arrow on the MACD histogram telling us that we've lost momentum within the market. And then we have a red arrow on the stochastic telling us that we are trading near the lows of recent price ranges, not near the highs of price ranges. And so that's a little bit more of a bearish feature as well. Now, obviously, there is nothing that works 100% or anything along those lines. You use it in conjunction with the other things that you're already doing, but it at least confirms with us that we're seeing more struggling here since August 1st than robust buying activity, at least from my perspective. So S&P 500, NASDAQ Composite, and Russell 2000 all have 3 red arrow signals. The Dow managed to escape that destiny because they do still have their green arrow on the MACD histogram, but the other two are red even on the Dow. And then on the 1040 crossover method, this is chart 4C for those of you following along at home. Here, a little bit better news, because remember, this is a less sensitive approach to the markets, because here we're using weekly candles, not daily candles like we were with the other couple of charts that I showed you. In this case, these charts go back 3 years in time, and each one of these candles represents 1 week in time. And the orange line in this case will represent the 10-week moving average, and then the blue line will represent the 40-week moving average. And what we're looking for there are crossovers. At this moment, we continue to have bullish crossovers across all 4 of these. The one that continues to be the one that is the most likely in my eyes to have a bearish crossover, if that is in the cards, will be the Russell 2000. You can see we are very, very close to having a crossover. Those 2 lines, the orange and the blue, are kind of getting pinched together, whereas you can still see separation between the lines up here on these other charts. If I were to right-click and then maximize the sell here, you can see a little bit better how tight it is. I mean, they're almost touching each other right now. That's how close it is. And remember, that would line up down below with the PPO as well. When this green line down below crosses kind of that dotted orange line, that will be when those 2 moving averages cross one another. So that could theoretically happen within the next couple of weeks. So we'll keep our eye on that possibility there as well. But for the moment, they're still enjoying the buying activity that the market had here earlier in 2023, despite a little bit more turbulence here as we've headed into the end of the summer, early fall. All right, let's go ahead and pop on over here to the internet. I always like to get a chance to say thank you to those of you that help support these presentations. And as you can see here, we had over 100 folks that clicked like for me the last time I did the video here on Thursday. And so anytime we're up and over 100 likes, I will plan on doing a full-length video, including a trade application example, the next time I'm scheduled to do the video. But again, I'll remind you, just in case somebody fast-forwarded before when I said it previously, I won't be here this Thursday, but I'll still do the same deal with you. If we're up and over 100 likes, then next Tuesday when I'm back with you, we'll do another full-length version of that video. So thank you to the 103 people that took the 5 seconds out of your day to help support David and I here with our independent fledgling business that we operate just us two. Let's go ahead and do some shout outs here to some of our most supportive members. Thank you to Ron and to Jim and to Ken and to T-Fib and to Brandon and to Vernon and Violina and Pierre. He does a good job with dividend growth stuff as well. Thank you to Arthur and to DGI and Options Daily and to Paul and Wayne and Jim and Austin and William and Ayakipa and Sandeep and Trunk, Linda, Pat, Ken, BZ, Japan, Carl, Tao, Brad, Nick, Paul, Robert, Irene. The list goes on and on and on. I can't get to all of you. Thank you to Kenneth and Phil and others as well. But anyway, I'm hoping that every so often you hear your name get rattled off, just because I think sometimes when we ask you to do this, you might be wondering on your end, do you guys even notice that I am helping support you? And I do. I see all of the likes come in. So it means something to us, and we really do appreciate that. Please keep that up. All right, let's also have a little chat here about the sector selector tool. So a reminder that I generally put this together on the weekends. Now again, with me being out of town this weekend, it might be a little bit different. I'm going to take my laptop with me, but I'm not sure I'll be able to find time set aside to do that, because I'll have a pretty action-packed schedule this time around. But generally speaking, it is Friday nights when I put this together, when I'm at my kind of traditional workstation. And so this is a couple of days old by now. But it still can give us a general sense as to trends that we might be seeing from a sector perspective. Remember, we use this tool in conjunction with the stock selector tool in my Monday top-down trend trading class to help us discover trade ideas and talk through our education for that class's portfolio. Of course, those of you that are dividend growth investors, you might look at this the exact opposite way. So in other words, trend traders are going to look at the rankings of these sectors and kind of concentrate their activities on the securities or the sectors that are at the top, because those are the ones that have the most relative strength. On the other hand, if you're a long-term buy and hold dividend growth investor, like those of you that would have joined me in my dividend growth investing class earlier today, where we bought our 12th stock out of our eventual 25 stock portfolio, in that case it was in the consumer discretionary space, you'll notice that consumer discretionary is just one example, really fell off of the cliff here this week. Now, as dividend growth investors, we don't mind that because we're thinking beyond just the next couple of months. We're thinking ideally in the next couple of decades. And when we can buy them cheaper, when stock prices go lower, of course, dividend yields go higher. You do have to be careful with that approach and only choose quality. Otherwise, you could end up with a yield trap, but we do our best through our education to look for safety of dividends there as well. So anyway, depends on who you are and how you're approaching the markets as to how you'll use this information from the sector selector. But the main approach and the reason it was created was for that Monday top-down trend trading class, where we're looking for relative strength within the market. And right now you can see we did not have a change at the top. We have now, let's see, 1, 2, 3, 4, 5, 6, 7 weeks in a row with energy in the number one position. And despite energy stocks selling off today, I have not seen enough selling to suggest that they are going to fall off of the top slot going into this upcoming weekend either. They are doing quite well, all things considered, compared to the 10 other sectors that are out there. So they've got a little bit of wiggle room, some grace period up there in that number one slot. On the downside, consumer staples remain dead last for the fourth straight week as well. But you'll notice, other than those two bookends, exactly at number 1 and exactly at number 11, everything else in between those two bookends actually changed positions. I should take that back, except for one. Communication services did stay exactly the same at 7, but all the others did have a position change, and that's kind of rare. We usually don't see that much in the way of change. In fact, just last week you saw that number 1, number 2, number 3, number 4, number 5 were all exactly the same. This week that was not the case. We had a big surge out of the financials. We saw a little bit of impact there in the materials as well. So some of the more commodity related plays are starting to pick up some steam there. And they kind of knocked information technology off of their perch. And I'm sitting here wondering if that is kind of your NVIDIA effect in this particular case, right? NVIDIA, of course, has been the talk of the town for much of 2023, but there hasn't been anything to write home about in the last couple of weeks for NVIDIA shareholders. It's been a little bit more challenging there, so I do wonder if that's having a bit of an impact here within the technology sector itself. I mentioned that you had the big drop in discretionary as well. I don't think that's a very positive sign for the market, right? What we would like is for the sectors that we consider growth sectors to be leading the market. That's generally perceived as a sign of health for the market. And what we've seen here with the selling in the market more recently is kind of the opposite of that. And remember, that's a little bit of a change, right? Sometimes it feels like there's hardly any change going on at all, and we're always saying the same thing over and over. Well, that's not the case right now. We're actually witnessing with our own eyes that change taking place. Now, how long it lasts, of course, is anybody's guess. But what we do know is that we are seeing information and statistics alter our way of viewing these markets. And right now, technology and discretionary are problematic with their big drops in these rankings. Now, what we haven't seen tremendously yet is a huge move higher in the defensives. We did see utilities pop higher. So, one thing I mentioned to my students here yesterday morning was that technology is actually at its worst position in the last 3 months. If you backtrack this bright green color with the dots and the chain there, that the fourth place position is its worst position. Prior to that, it had been in third place a number of times, but it had never been as low as 4 in the last 3 months since basically the end of June. Now, on the flip side of that conversation, notice utilities down below. Not that the 8th out of 11 positions is particularly exciting, but the fact that you are at your highest level on utilities in the last 3 months is also somewhat noteworthy. Prior to this week, utilities had always been either last or second to last for the entirety of the last 3 months. So we are witnessing change taking place right here before our eyes. Some slippage in technology and discretionary, some improvement in utilities, and the other interest rate sensitive category of real estate, and some nice moves out of financials and materials as well. So all of a sudden it kind of feels like there's a lot of different balls in the air here, whereas previously it kind of felt like deer looking in the headlights, nothing was changing type of a thing. Now all of a sudden it feels like everything's changing. So we'll see where things shake out here in the coming week, but wanted to share that with you because that was definitely noteworthy. All right, let's go ahead and pop back on over here to the Thinkorswim platform. And let's do some 12 grid analysis, starting with chart 5A. This is our asset class 12 grid. And a reminder that when you're looking at the background colors of these charts, the green charts will tell you that we have a bullish intermediate posture on the market forecast technical indicator. The pink charts refer to the bearish postures. The last time I was with you, I believe it was the last time. Sometimes these different classes that I teach blend together in my head, but I believe it was the last time we were together that I had mentioned the rarity of that particular day, that we had nothing but green charts on this chart 5A. That's incredibly rare. Some of these financial instruments are designed to do the exact opposite of one another. Something like TLT generally is viewed as the opposite of TNX, yet on Thursday all of them had green charts. Well, fast forward to today, just a few trading days later, and we now have the more traditional relationship once again. The bonds are back to their bearish postures when we have interest rates with our bullish postures. And there was actually a pretty solid move higher in interest rates once again here today. In fact, this was a multi-month closing high today. I'm not sure if we quite got above the intraday high back here on August 22nd, but certainly on a closing price basis, we closed basically at the highs of the day on the 10-year Treasury yield. So, there is still this kind of mindset of higher for longer, it feels like, out there. Now, of course, we might hear from the Fed tomorrow. It's Fed Day. I'm not sure if we're expecting much in the way of change, but hopefully they can, with their press conference and words, kind of guide us as to what to expect moving forward from here. There are a lot of people that feel like by this time next year, the Fed will be in cutting mode. Whether that happens or not, of course, anybody's guess. But, that's what the financial markets are kind of pricing in here at the moment. But for right now, in the here and the now, we still have higher than average interest rates, which generally is a bit of a headwind for the stock market. Right, that can be a good thing for those of you that are saving your money with CDs down at your bank or buying U.S. Treasury bonds with above average coupons and yields right now. But generally speaking, higher rates comes with higher financing costs for corporate America, and the higher their debt servicing payments, the less money that remains after that process for shareholders. And of course, we prefer it when we have more money left over, not less money. And so more money could very well be funneled to the bondholders and less money to the stockholders as we move forward if these rates do remain high. And right now I have no reason to believe that they won't, because as you look at this chart, how many times have I said it over the last several months? It's a beautiful looking chart. If only this was actually a stock and not interest rates. That is the problem. But as you look at that TNX chart, I mean, it's a thing of beauty. Every time it comes down to the moving average, it bounces off of it, comes down, bounces off, comes down, bounces off, and so on and so forth, and just gradually works its way higher with higher highs and higher lows. So that is the epitome of an uptrend right there, which is not a great thing for the rest of the market. So TNX did close with a yield of 4.36% today. TLT, which tracks the prices of long-term bonds through an ETF form, was down 0.74% today. You can see we're back to strongly bearish posture at a time when we have a strongly bullish posture on yields. So that is kind of in alignment with the traditional relationship between those two instruments. Foreign bonds also struggled here today. They were down 0.19%. They also have a strongly bearish posture, and just like their other bond categories, are trading below their falling 30-day moving averages. And then high yield bonds also closed lower today, down by 0.31%. In this particular case, they're the only one that has this lighter shade of pink, so that's telling you that there's a little bit bit more resilience in the junk bond market than there are in some of these foreign and government categories. Nonetheless, as you look at that chart there, it doesn't look particularly healthy. It just is holding up a little bit better. It's kind of in the middle of its 3-month range as opposed to way down below here, the way that TLT is threatening to break to multi-month lows, right? We're not that far away from it. So, and the same thing goes for foreign bonds, whereas high yield bonds would have to make quite a tremendous move down here to their lows back in July. So I think that's safe at least for a while here. But it is, as I mentioned before, below its falling 30-day moving average. In terms of the lower left-hand corner now, U.S. dollar has certainly been an interesting story this year as the dollar has continued to strengthen and strengthen and strengthen since putting in these lows here in the middle of July. And generally speaking, when the dollar gets strong, that's not a positive thing for foreign securities, and it's usually a little bit of a headwind for commodities as well. Today, gold was down on a day when the dollar was up, but oil, again, dancing to its own tune, which has been the case for much of the last 3 months. That's nothing that's all that uncommon for this particular moment in time. So, not a lot of people are talking about oil, but if you pull up /CL, a barrel of oil right now is going for $91. I mean, we're not that far away from that big round number of 100 that would have scared the heck out of this market just a few years ago. So, that's another sign of inflationary pressure that we're dealing with there with oil. And it just seems like it goes up without abandon day after day after day. Today was not a huge up day for it. It was only up 0.06%, but still the fact that it was up is kind of noteworthy, especially considering a lot of those oil stocks were down. But oil, the commodity itself, was up, and that doesn't happen a whole lot either. But today was kind of a rare day from that perspective. In terms of those foreign stocks up above here, you will notice that EFA, which tracks the developed foreign stocks, actually outperformed the U.S. market, which is not necessarily what we would have expected with the dollar up today. But EEM, the emerging markets, kind of fulfilled their traditional role where they underperformed the S&P 500 today. They were down 0.59%. Neither of the charts look particularly healthy. Then again, neither does the U.S., right? We're in a little bit of a funk right now across equity markets across the globe. Now, there's some handful of countries here and there that are holding up a bit better. We've talked about some of those in my trend trading classes. Some of the India ETFs are holding up a bit better. Some of the Japanese ETFs are holding up a little bit better. Turkey was doing a little bit better for a while. Greece was doing a little bit better for a while. Vietnam was doing a little bit better for a while. But those are the exceptions. The vast majority of countries outside of the United States are struggling right alongside of the United States at this moment in time. Preferred stocks were up 0.03%. They do retain their strongly bullish posture. They're above their falling moving average here at the moment. And then Bitcoin was up about 1% today. They're at an important juncture right now in the chart where they're trying to figure out if they want to get up and over that falling 30-day moving average. We closed above it, which is why that moving average changed from red to yellow here today. But as you can see, it wasn't an emphatic move by any stretch of the imagination, right? This was a move that tried to get something going earlier in the session, but then settled back in. So, we're basically in kind of a holding pattern right here at a key resistance area. But if we have a big move, 4 or 5% or something to the upside tomorrow, then all of a sudden we're going to have a different conversation. Right now we have to assume that resistance will hold, but we will await further information from the charts themselves. And right now we're at that important resistance area of that downward trending 30-day moving average. Let's now go on over here to our sector 12 grid. And as we're pulling this up here, you can see we have a bit of a mixed bag in terms of the various sectors that are out there. Some of them have bullish postures, some of them have bearish postures. So there's a little bit more of a tug of war, and based upon what we saw on the sector selector, that seems to make sense, right? We had a transitory type of a week where we saw rankings flip-flopping all over the place. And so no real big surprise, at least to me, that when we come over here on this 12 grid, that we see a lot of disruption here as well. And you don't just have a universal selling or buying that's taking place. You have a mixed bag out there. So let's see what we can discover. Let's start with the green charts here. So the one on top is communications. Now keep in mind this is the market cap weighted version of communications, when we were looking at the sector selector before, that is an equal weighted version. Sometimes there's some slight differences. Communications is one of those areas that you can have a bit more of a difference because this particular ETF XLC is really dominated by Alphabet and Meta. And so their prospects of this ETF are driven really by those two companies. So that is one that is managing some strength above their moving average right now. But those other two growth sectors of technology and discretionary, they're struggling a little bit more. And they've got those bearish postures here at the moment. So kind of a mixed bag in the growth sectors here. In the middle rung, where we have more of our cyclical sectors, you have financials off on the left-hand side here. They remain above their moving average as well. In this case, the moving average is declining, as it is with communications. But there's enough strength off of the lows of financials here in the last couple of weeks to have that posture shift in that case. So is that a great looking chart? Not necessarily, but does it look better than a lot of these other charts? Sure. Everything, you got to look at everything on a relative basis. Off on the right-hand side here, where we see energy, notice that we do have that green background color. We have a green 30-day moving average. The only other chart that can make that claim of those two things coexisting at the same time is utilities. And then when you look at energy chart versus utility chart, I think it is glaringly obvious that it's the energy chart that looks much, much better than the utility chart. Not to say that that will continue into the future, but if you believe in the concept of the trend is your friend until the end, then your eyes are a bit more attracted to the oil companies right now than those in the utilities that are just trying to get off the bottom, right? We talked about all these oversold cluster signals on the utilities here a couple of weeks ago, and we had quite an impressive move, right? Like we saw there on the sector selector, utilities went from, I think it was the 10th position up to the 8th position. So that was as a direct result of the utilities basically going up day after day after day for about 7 or 8 days in a row right there. So perhaps we just got a little too aggressive of selling in that area, and this is a more natural place for it to be hanging out right here. So those are our green charts. All the rest of them are in the doghouse. They're all in that bearish posture. In terms of the ones that kind of look the worst, I would probably say, real estate's starting to look a little bit more challenged here as we slip to multi-week lows, not multi-month lows, but multi-week lows. Materials doesn't look particularly good. Staples doesn't look particularly good. At least healthcare managed to close in the green today, so we'll give them a pass here today. But industrials doesn't look very good either. We've actually sold an industrial stock for each of the last 2 Mondays in my top-down trend trading class. Earlier this year, the industrials were all the rage. They were kind of carrying our portfolio. Now, of course, we have NVIDIA in that portfolio as well, so that was truly the talk of the town. But, underneath kind of the superstar stocks out there, you had your quiet industrials companies that hardly anybody was talking about that were really making nice moves. But that seemingly has changed in the last month or so. You can see quite a difference in sentiment around the industrial sector over here where we're trading now versus where we were back here in July when it just seemed like these suckers were going up and up and up and up and up. Notice that we did get an overbought cluster signal on industrials back here on July 26th. So perhaps that was a little bit of a warning sign that things had gotten a little too overheated to the upside. We needed to correct that by giving some of those gains back. So right now, industrial's not looking particularly strong. In terms of who today's biggest winners and losers were from a sector perspective, the biggest winners were almost identical. It was healthcare, which was up 0.08%, and communications just barely behind it, up 0.07%. But let's be honest, both of those are kind of yawns, right? They're not big moves, but the fact that they avoided the selling at all was probably a good sign there. In terms of who the worst performing sector was here today, let's see, was it energy? Yes, I believe so. Yep, energy was down 0.93%, so not quite 1%, but close to it. And that doesn't surprise me, based upon what we already discovered there on the heat map earlier in the presentation. It did seem like the oil stocks were all consistently lower with the brightest red squares compared to kind of more of a mixed bag with most of the other sectors that were out there. So today, energy had a rare sell-off day. But again, you can cut it some slack. I mean, take a look at this move. It's up. Energy's up 16% even after today's pullback, right, over the last 3 months. You look at these numbers off to the right hand of each of the charts, and nothing even comes close to a 16% move, right? The second place is probably communications right here, up 4.8%. That is a tremendous difference compared to the energy stocks. They are night and day different. So you have one big winner of energy, and then you have a lot of other sectors that are kind of trying to vie for second place way down below. So when you take that into the back of your mind, it's a little bit more forgiving to say, you know what, energy, you've had a good go of things here lately. You can afford to give a little bit of that back, and we'll still keep you in our good graces for the moment. So we're still above the rising 30-day moving average, still with that strongly bullish posture. But it is true that today energy was the one that sold off the most. All right, let's get into our trade application example here for the day. And I'm going to pull up just a swing trading chart here, chart 3A. And I'm going to pull up Adobe. Some of you might have caught that when I was talking about the performance on the heat map. I said we're going to talk a little bit more about Adobe a little bit later. And the reason for that is this is the stock that I chose for our trade application example here in tonight's video. And it had a pretty nice performance today. I don't know if there was any news associated with it, if they got a brokerage upgrade or anything like that going on. But what I can tell you is they had a very nice day. Adobe was up 1.74%. This is ticker symbol ADBE. When you're up almost 2% on a day when the stock market itself is down, that's some pretty good outperformance, at least on a one-day basis. And of course, it's not just one day. You look at this dotted gold line down below here, that represents the pathway of the S&P 500 over the last 3 months of this chart. So had you had an opportunity to put $10,000 in Adobe stock or $10,000 in the S&P 500, you would have been better served being in Adobe stock. It has beaten the market during that time period. And you can see the numbers up above here are quite extraordinary as well. On a year-to-date basis, Adobe's up 60%. On a 1 year rolling look back, it's up 75% from where this stock was trading in September of last year. So it has been one of the big winners here. Remember, there is a bit of an AI theme that gets played with Adobe. They are the company behind Photoshop, as just one example. And while it may seem like artificial intelligence may threaten their business model by being able to generate other images outside of Photoshop, Adobe has tried to harness the power of that artificial intelligence within their own product to produce even a more superior product for marketing professionals and things like that. So anyway, a pretty good success story there of a company that was really, really early in moving towards a cloud subscription model. They have become one of the true giants in the tech world over time. So what caught my eye today, of course, as I mentioned, the immense outperformance versus the market at large. This was actually back-to-back nice days for it, where we closed near the high of the session yesterday. We closed near the high of the session today. Today was an important candle from the perspective of the posture of this chart. Remember, this particular chart is going to emphasize the blue line on the market forecast, not the green one. So we use this for swing trading purposes rather than trend trading. And from that perspective, you do have that blue line rocketing higher once again, which is now coloring the background of this chart back to that blue color, kind of telling us it's a little bit more bullish as a bounce candidate. It might not be a breakout candidate yet, the way that you might want as a trend trade, but as a bounce candidate, it seems to be somewhat appetizing. You'll notice here that it also has a green moving average here at the moment. And so that constitutes a stock that is currently trading above its rising moving average. And as you can see back here over the last 3 months, generally speaking, when it comes down to the moving average, it doesn't spend a lot of time below it. It seems to kind of gather itself and use that 30-day moving average as a support area. And that's seemingly what is taking place here in the last 2 or 3 days as well. And so you'll also notice that they've already reported their earnings. So that's out of the way. We don't have to let that disrupt us. Remember, we're about ready to head into earnings season again here in less than a month. We'll be talking about the banks with their earnings, but Adobe is one of the off-cycle earnings reporters out there. And so we actually have basically 3 full months before we hear from Adobe with their next earnings announcement once again. Anyway, what I opted to do for today's trade application example is what is known as a bull-put spread. A reminder for those of you that aren't familiar with that terminology, that is what we would also refer to as a credit spread. In other words, we are selling one put contract with a higher strike price, and we're buying another put within that spread with a lower strike price. And because the put with the higher strike price has the higher premium as well, it creates a credit rather than a debit. And that establishes kind of our break even for the trade as well. And what I did in this case is I went out to November. Again, remember, this is an off-cycle one, so even going out to November, it won't be reporting earnings between now and then unless something major changes with the company. But it is a November monthly contract, and we are looking at the 505 as the sold strike and 500 as the bought strike. So that creates a $5 wide spread. We took in a credit of $1.15 when we sold that, which represents a 30% return on risk. And then that gives us a break even on this trade of 503.85. And I've kind of drawn this black horizontal line here to help us visualize where our our difficulties would be if this stock rolled over and sold off, right? Because of course we're not going to get them all right. We're going to have lots and lots of losing trades, just like we're going to have lots and lots of winning ones. That's the nature of working within the highly variable and unknown financial markets. But hopefully we have better decisions than not, more times than not. And in this case, if you are hoping that this will lead to a further bounce off the moving average, just like it did back here, then that should create separation between Adobe's share price and this black line. The further away it gets from the black line, the more comfortable we feel that we made the right decision. Is if Adobe, on the other hand, rolls over starting tomorrow or next week or whatever, and starts heading towards the black line, then all of a sudden, we're going to have a little bit more concerns with it. But as most of you are aware, when we sell a put spread, we do have defined risk. It doesn't mean you can't lose money. It just means that if this thing really imploded and started really selling off to like 400 or something like that, we would not lose more and more money as it kept on going lower and lower the way that you would if you were just buying the stock outright. In this case, since we've set this up as an option spread, we know what our worst case scenario is when we get started with the trade. So, and we position size accordingly for that, right? So anyway, that was the trade idea here today on Adobe. I'm going to wrap it up a little bit earlier than I normally do. I hope you don't mind. As I mentioned before, I'm just not feeling up to snuff here at the moment, feeling a little bit like I could use a pep in my step, but figured I didn't want to disappoint you by not producing the video here tonight, especially since I'll be out of town here on Thursday. So anyway, I hope you guys enjoy the rest of your week, and as I mentioned before, I'll be back on Tuesday next week, so while I won't be here with my traditional Thursday video, I will plan on being back with you here a week from tonight, and as long as we're up and over 100 likes on Twitter, as you guys have done a good job with here in recent weeks, I'll plan on doing another full-length video on that day for you as well. On the other hand, if you prefer the 15-minute version of the video and we're under 100 likes, then we'll just kind of stick with one of those short and easy ones there. So we'll let you guys decide there collectively what you want out of this video. But whatever you decide, I appreciate you checking out tonight's video, and I want to wish you all the best of success with your trades and your investments. Goodbye for now.